Hi, this is Danielle DiMartino Booth, and I am the founder, CEO, and chief strategist of QI Research. I'd like to thank you for taking a few minutes to watch this short segment and hear my latest thoughts on the markets and the economy, and of course, monetary policy here in the United States. Thank you for your feedback. Please, if you don't already follow me on YouTube, please do so and invite your friends to come and watch as well. Take care. Bye-bye.
All right, it's early, but I'm pretty sure it won't go down in history like transitory. But Federal Reserve Chair Jay Powell's no hurry comment late yesterday sent the stock market reeling. Listen, Jay Powell says that inflation is moving at what he calls a sometimes bumpy path toward that 2% goal. He also says the economy is not sending any signals that we need to see to hurry lower rates. Now, there are several camps that look at this and some of the other actions by the Fed recently, and they're wondering, right? Some think maybe the Fed has been unnerved by just how quickly the Trump team is coming together. There's another camp that maybe the Fed cut too soon, but maybe they can't admit it. Also, they may have a new neutral rate. And then there's just another camp that simply says the Fed has lost control. I want to bring in now QI Research CEO and chief strategist Danielle DiMartino Booth. Danielle, I want to start with this report out this morning, the Empire Fed survey. And the reason this is so intriguing to me, it was taken between November 4th and November 12th. So almost all of this after the election. And it was a massive surprise, a massive upside surprise. I mean, this is a huge shift. And I'm wondering how much of this shift you can see these big spikes here may be because of Trump being in office and sort of these manufacturers already making adjustments.
Charles, I think that if that's the case, we've got a case of premature paranoia here, especially if we get somebody as rational as Scott Bessent in as Treasury Secretary, and he's going to be encouraging nearshoring and onshoring before imposing penalties. I think there's a little bit of concern out there that might not be warranted. And furthermore, the last time that I was on set with you, we talked about backlogs. Backlogs went from -2 to -10 in the Empire State. So whatever they're seeing, they're definitely seeing as being a temporary knee-jerk moment, but not something that's going to have that's going to have legs.
All right. So again, because the prices prices received 6 months ahead. I mean, they've gone right through the roof. So I think, obviously we want to pay attention to that. But I feel like this is more the adjustments for the Trump than anything else. We talked about the Fed. They put out a research report in 2018, and it was about the role of inflation. It noted that inflation expectations might run persistently higher than the tariff when tariffs are around. That will lead to higher pay. All right, we're going to bring up this exact statement for a moment for the audience to see. And I wonder if this is what the Fed, you think the main thing they're talking about right now, that the labor market, or a tight labor market, would see higher wages because of tariffs.
Well, they could be having that discussion, but of course the labor market in 2018 was a much different beast, Charles. We know from Advance Auto Parts yesterday, they're going to be closing 727 stores and 4 distribution centers. Announced layoffs are running at 100,000 in November. They were 110,000 in October. That was double off of what they were in September, about 50,000. Right. So it's a different labor market. And I think that the Fed, the reason you're hearing from some of the doves, Austin Goolsbee, Susan Collins today, they're both going to be voting on the Federal Open Market Committee in 2025 all year. I think there is growing concern among some, Charles, that this is not the same labor market that we had the last time that Trump started a trade war.
All right. So back when Powell, started hiking rates, I don't know that the financial conditions ever got to where he thought they were good. I'm not sure a lot of the things he looks at got to where it was supposed to get to. Now we've got the economic surprise index that continues to go up over and over and over again. Does the Fed have control over any of this anymore?
Well, the Fed certainly doesn't have control, Charles, over the data flow. They've got control over the prices of goods. They've got control over the prices of some services. But as they say, interest rate is a blunt monetary policy tool, a blunt tool. Right. And the Fed should not have control over a lot of the economic data and a lot of the upside that we're seeing. By the way, I've been talking to my colleagues all week long, and they're saying, Danielle, This is not what we're hearing from the companies on the ground. And I heard that this morning about retail sales. We're not hearing this from companies across America that retail sales are going bonkers. Is this maybe just more a reflection of latency and high prices that have lasted? Because they're not seeing it from the CEOs and the CFOs and from people selling products and services to Americans right now, Charles. There's a big disconnect between the data and what's happening on the ground.
Right. And I do want to point out to the audience that there's also a major difference between a news that's better than expected, right? If you thought it was going to be minus 10 and it was minus 8, Wall Street breaks out the pom-poms. So minus 8, not necessarily good either. Danielle, thank you so much for walking us through all of that. Appreciate it.
Thank you, Charles. Have a good weekend.
See you soon.